In the last videos, we discussed bond basics, the accounting to record the entries for bonds issued at par, and now let's look at bonds issued at a discount. As we've discussed so far, the contract interest rate is the rate stated on the face of the bond. It is the rate that is used to calculate the semi-annual payments made by the borrower, the bond issuer, to the lender, who is the bondholder. The payment is calculated by multiplying the par value of the bond times the annual contract rate and dividing by 2. This rate does not change, and although it sets the semi-annual payments to be made in cash, it does not necessarily determine the bond interest expense incurred by the borrower. So let's explore the impact of market interest rates on the next couple slides. As you recall, bond market interest rates change frequently due to global events, inflation, news stories about unemployment, a downturn in the economy, the national mood, you name it. They can be hard to accurately predict as a result. For our discussion, remember, the bondholder is the lender, the investor. They are being asked to trust that the bond issuer will repay their money. In return, they demand a reasonable interest rate to compensate them for the risk of not being paid back. In the corporate bond market, an investor will demand a higher interest rate when there is some perceived risk associated with lending money to the borrower. Perhaps the company is in an industry which doesn't have a great economic outlook. Falling oil prices make fracking companies not look so great, for example. Or perhaps there has been fraud at a company, like we saw recently with Volkswagen and its smog emissions cheating scandal. Volkswagen's cost of borrowing increased immediately in the global bond market after the scandal came to light. In addition, the market interest rate is often higher when the time period until the bond matures is longer due to the risk of adverse events occurring over a longer time period. Market rates are all relative. They are also affected by the availability, the supply that is, of other similar investments in the marketplace. When the bond contract interest rate equals the market rate, investors will pay the par value for the bond. In most cases, however, the contract rate will not be equal to the market rate, and so the bond does not sell at the par value. Remember, we can't just change the contract rate. Companies hire investment bankers and attorneys and CPA firms to prepare for their bond issue. It's a big deal to lend money to the public, and bond issues are highly regulated. As a result, bond certificates are pre-printed with all the details about the bond well in advance of the bond sale. You might draw a box on a piece of paper to represent a bond you are selling. Use a pen to write if you have one available. Include in the box the par value of the bond, the interest rate, and the dates of issue and maturity. Okay then, so you're stuck paying those amounts on those dates. You can't just erase them or cross them off if you feel like it. It's the same for a company selling a bond. They must pay the amount stated on the bond. The only thing that's not printed on the bond certificate then is the selling price of the bond. So, the company selling the bond and the investors must come to an agreement about the selling price that incorporates the difference between the contract interest rate and the market interest rate. Remember, we are talking about an investment marketplace. Investors have choices about what investments they'll buy. The difference between par value and the amount of cash the bond sells for is called a discount or a premium. This screenshot illustrates 3 bond issuances. In all 3 cases, the market rate of interest is 10%. The printed bond document interest rate changes. In the middle example, the contract interest rate of 10% is the same as the market rate of 10%. This means that the bonds will be issued at par face value. On the top example, the market rate is below the contract rate. That means that the investors are getting a nice semi-annual payment They will be paid 12% on the bonds they purchased rather than the current market rate of 10%. Since they're getting a great deal, the company is going to adjust the sales price up and sell the bonds at a premium or more than the par or face value. The bottom example illustrates when the market rate of 10% is more than the 8% contract rate. Why would an investor loan us money when they could go elsewhere and earn more interest? To entice them to invest in our bonds, then, we sell the bonds at a discount for less than face value. In this example, Fila Company is issuing bonds with a par value of $100,000 and a stated interest rate of 8% with interest payable semi-annually on June 30th and December 31st. Remember, these are the facts that are printed on the bond contract. However, the market interest rate on the issue date for financial instruments with similar risk is 10%. Now, if our bond is paying 8% and the market is paying 10%, how many investors will want to buy our bonds? None, right? So we have to make our bonds more attractive by reducing the selling price to make up the difference in the interest rates. So we'll sell the bonds at a discount. In this example, Fila Company sells its bonds for 96.454% of its par value. Because this percentage is less than 100%, it tells us the bonds are being sold for less than par value. The discount in the selling price raises the effective interest rate that the investors will earn to 10%, and the effective interest rate is the actual rate of return being earned by the bondholders and the actual rate of interest expense incurred by Fila. Fila will receive cash of $96,454 from the bond issuers. Note that the cash received is computed by multiplying the par value of the bond on the bond document by the market issue price of 96.454%. This is important. You will need to be able to calculate the cash received if I give you the issue price as a percentage of the par value. So we receive only $96,454, but we have to pay back the full $100,000 at the maturity date. The difference between the par value of the bonds and the cash price received is the discount that we offer to the bond investors. Remember, the whole reason we offered the discount in the first place is because of the difference between the stated or the contract rate and the market rate of interest. As a result, the discount represents an additional interest factor that will be amortized or systematically allocated to interest expense over the life of the bond. Amortizing the discount will increase the total interest expense recorded for the bond to equal 10%, which is the market rate of interest. It's actually pretty cool, but very complicated too. So how do we record this in the books? On the issue date, Fila will debit cash for the amount of the cash proceeds. They will credit bonds payable, which is the liability account, for the par value of the bonds issued, and debit discount on bonds payable for the difference between the two. The discount on bonds payable is a contra liability account and has a normal debit balance. As a contra liability account, picture it as being married to bonds payable. The two always go together. Don't assume it's an asset because it carries a normal debit balance. As can be seen on this slide, immediately after the issuance, the bonds payable account should have a credit balance, and the discount on bonds payable account should have a debit balance. These bonds are reported on the long-term liability section of Fila's December 31st, 2015 balance sheet. The amount of the unamortized discount, or that which has not yet been allocated to interest expense, is subtracted from the par value of the bonds to arrive at the carrying or the book value of the bonds. Discount on bonds payable is a contra liability account. For a moment, then, let's consider how much total interest expense Fila will incur as a cost of its borrowing. Fila receives $96,454 for its bonds In return, it must pay bondholders $100,000 after 2 years, plus semi-annual interest payments of $4,000 each, for a total of $116,000. Notice that the $3,546 discount is paid to bondholders at maturity and is part of the cost of using that $96,454 for 2 years. The calculation shown on this slide shows that total bond interest expense over 2 years is $19,546. It can be calculated 2 ways. The easiest way to think about it is as follows. Total interest expense is the difference between the total amount repaid to the bondholders of $116 and the amount borrowed from the bondholders of $96,454. Alternately, we can compute the total bond interest expense as the sum of the 4 interest payments plus the bond discount. This alternative computation is shown in the lower portion of the slide. Since the $4,000 we pay semi-annually is not FILA's actual interest expense, what do? What amount of interest expense is recorded when the semi-annual payment is made? And that's easy. Divide the $19,546 in total interest expense by 4 payment periods to get $4,887. Now, there are 2 ways to amortize the bond discount, but our course will keep it simple and use the straight line method. The straight line bond amortization method allocates an equal proportion of the bond's total interest expense to each interest period. To apply the straight line method to FILA's books, we divide the total bond interest expense of $19,546 by 4. Those are the number of semi-annual periods in the bond's life. This gives us a bond interest expense of $4,887 per period, rounded. Alternately, we can find this number by first dividing the $3,546 discount by 4, which yields the $887 amount of the discount to be amortized each interest period. When the $887 is added to the $4,000 in cash payment, the bond interest expense for each period is $4,887. FILA will make this entry to record bond interest expense and update the balance on discount on bonds payable account every 6 months on June 30 and December 31st. It's easiest to start with cash, right? So cash is credited for $4,000, the actual amount of cash interest paid to the bondholders, and printed on the bond contract. It is calculated as par value times the stated interest rate times 1/2 a year. The credit of $887 to the discount on bonds payable account is determined using the straight line method, as we just discussed, and the debit to bond interest expense is the total of the 2 credit amounts in this entry, or $4,887. An amortization table illustrates the interest payment, the interest expense, discount amortization, unamortized discount balance, and the carrying value of the bond for each interest payment over the life of the bond. This slide shows that the pattern of decreases in the discount on bonds payable account and the pattern of increases in the bond's carrying value. Notice while FILA actually pays $16,000 in total contract interest to the bondholders, actual expense is more. It is $19,546. It's higher because of the discount given to the bondholders up front. The following points summarize the discount bond straight-line amortization. First, at issuance, the $100,000 par value consists of the $96,454 cash received by the issuer plus the $3,546 discount. During the bond's life, the unamortized discount decreases each period by the $887 amortization, and the carrying value, which is the par value less the unamortized discount, increases each period by $887. At maturity, the unamortized discount equals 0, and the carrying value equals the $100,000 par value that the issuer pays the holder. We also see that FILA incurs $4,887 in bond interest expense each period, but pays only $4,000 in cash. The $887 unpaid portion of this expense is added to the bond's carrying value in recognition that it will be paid when the bonds mature. Instead of using the straight-line method to amortize the discount, some companies use the effective interest method. The effective interest method applies the market rate of interest to the carrying value of the bond to determine the amount of amortization for each period. The effective interest method of amortizing a discount or premium is discussed in the appendix of your textbook. You are not responsible for learning the details of this method. There will not be any homework, quiz, or exam questions on the preparation of entries using the effective interest method. Okay, break time then. The next video will cover issuing bonds at a premium.